Yoojeong with us.
Yep, hello.
Hi Yoojeong, how are you?
Good, thank you. Thank you for having me.
Brilliant, thank you very much for joining us today. Brilliant, so we're here to talk about Aberdeen Asian Income Fund. Are you happy to just do a quick summary of the fund, and then we'll move on to some slides and then some questions?
Yep, that sounds great. I think the next slide will give you the summary. If I stick on this page for a little bit, then you can see the key attributes of the fund on this page. And I would particularly like to draw your attention to a couple of spots here. So the fund has delivered double-digit NAV returns during the pandemic years, and that NAV has kept pace. It's kept pace with or outperformed the benchmark MSCI Asia Pacific ex-Japan Index across all time periods. And we've especially benefited from our quality value style, looking at strong balance sheets and defensive business models during the past 2 years. You can see that the fund has also outperformed the regional high dividend yield index, which we provided here as well. So that's the value index for Asia. So we've been doing well against both these different indices. The dividend yield is pretty attractive. It's just around 4%, and we've maintained a growing dividend per share for our shareholders for 13 consecutive years now. And you'll also note that the board has committed to a minimum dividend for 2022 already of 9.75 pence per share. On the left-hand side, you can see some of our sustainability and ESG ratings provided by third-party companies, and we're ranked higher than that of the benchmark MSCI Asia Pacific ex-Japan Index. And that's something that we work on very diligently as well as a team of analysts and fund managers. And the last thing I want to point out is the gearing level in the bottom right corner of this slide. And we raised our gearing slightly during 2021, so we're just about 10% geared at the moment. And that's modestly enhanced our returns over the course of the past year, especially given that rotation that we have seen in the markets from growth to value. And if we go on to the next slide, please. This is really just to outline our investment process behind the Aberdeen Asian Income Fund, which is a bit of a mouthful, so maybe I'll just call it AAIF from now on, as you can see on the top left, as we target the income and growth potential of Asia's most compelling and sustainable companies. I think the key things here are that we have about 40 fund managers and analysts based in Asia. I'm in Singapore, for example, and we are all looking for the highest quality dividend paying ideas in the region. This team has been in Asia for 30 years now, so we have extensive knowledge of markets and companies across Asia. And ESG as a second bubble here, that's always been a core part of our quality process. And we've been engaging with our companies for well on 20 years now. And this covers all aspects of environmental, social, and governance issues. And you saw that on the slide before in terms of our ratings from these third-party providers. We look for quality income companies on a bottom-up stock selection basis. So we're really looking to invest in companies that we can understand, where we can model the cash flow generation and dividend paying ability into the future. And I think that's something that's always key in terms of what we're looking for. We've been building our revenue reserves during the life of the fund as well. And I have a slide coming up later, but I do just want to point out a typo on this page where we've put the numbers in the wrong way round. So the dividend cover is just under 50%. It's not what's written here in the last box, but we'll come to that in another slide. So you'll have the real data coming up very shortly. Maybe we could skip ahead 2 slides because I think I've covered a lot of the performance already. This one just shows our fund positioning, and you can see from a country perspective, we've really focused on those high dividend paying countries in Asia. So Singapore, Taiwan, Australia, all the fund positions are shown in the slightly brighter blue, and the benchmark positions are in dark blue. So you can see we're overweight the countries that are high dividend paying countries. And our big underweight is to China. And that's an underweight that we've had for several years now, because the growth in China has really come from those high momentum growth stocks, such as the Chinese internet companies. And we've chosen not to invest in those stocks, given they don't pay dividends. And that's a choice we made. And that's certainly been one of the drivers of performance over the past 2 years. If you look on sectors, then you can see very familiar to an income fund, we have high weights in financials and real estate. But where this Asia fund might differ from the UK or Western income funds that you're used to seeing is that we have very good, strong cash balance sheets and good dividend payers in the technology space. So we're able to find, the world's greatest technology companies in the likes of TSMC, for example, where we get very good dividends and we get good growth as well. And the flip side of that really is that we don't get the kind of big global pharmaceutical companies that you find in Europe and UK, with a big sort of back library of drugs that's generating cash flows. So you can see that we're underweight healthcare, for example. So slight differences in sectors in terms of dividend collection abilities, but that's really reflected here. We choose our stocks bottom up based on quality, but here we just show you how that breaks out into sectors. And if we go on to the next slide, then I think this is the dividend slide I wanted to show you. Then again, the dividend per share that we've been paying is shown in the slightly brighter blue, and the dark blue shows the revenue reserves that the fund has. And you can see that we're just about 45 to 50% covered for the 2022 dividend using revenue reserves alone. But of course, the hope is that we can pay that fully from the earnings that we have within the fund this year. So the minimum dividend you see here again that we've committed to is 9.75 pence per share for this year. And we're very hopeful to keep this AIC status of Dividend Hero Fund going forwards as well. And you can see our track record of how we've used those reserves in the past. And we've never used it until 2020, but we dipped into it in the last 2 years just to ensure that we could keep paying that dividend that our shareholders prioritize, because it's important to us as well. So that was the key highlights I wanted to do as an introduction to the fund, but I'm very happy to take questions as well.
Brilliant, thank you very much. Yeah, we've already got quite a few questions in so far. You mentioned that the fund is focused on quality. Does this mean that the portfolio is more expensive than the market? And what do you get in return for this? For example, high dividend growth?
Yeah, so I think it's very different on a sector by sector basis. So if you look at different markets in Asia, there can be a very different valuation premium depending on how you define quality. But we also have very high quality stocks that are trading on very reasonable valuations as well. So I talked about some of the technology companies already, but if you look at our biggest holdings in stocks like TSMC and Samsung Electronics, then we're really not paying anything above the benchmark average for forward earnings growth. And these companies are also contributing very well to our dividends as well. I don't think a good dividend payer has to be purely defensive. So we have some cyclical companies in the fund as well. And again, you can imagine you can follow the cycle to be able to manage that valuation for the company as well. So we're very aware of paying the right price and trying to manage the portfolio so that we add to certain holdings at certain times and we're taking money off others to fund that. So we're quite active in that sense. But we just want to make sure that the underlying quality metrics of the portfolio, so that would be lower gearing in the fund on a look-through basis relative to the benchmark, higher return on equities, higher operating margin. I think these are all quality factors that we want to be outperforming the benchmark for, and the fund has done that and still does do that. So that's how we measure quality. And I think if you look at valuation, then you'll see that this fund is very reasonable relative to the benchmark. You're not paying anything higher. So we're not going for the big expensive stocks in order to buy dividend. I think over the past 3 years, the high multiples have been on the high growth stocks. And we've certainly not been paying up to buy growth either. So we've benefited from a market rotation. But I think if you look at our fund valuations, and it's still it's low to mid teens in terms of forward PE multiples.
Thank you. And we've had a few questions about China, but I believe the fund is actually underweight China. So first of all, do you want to talk about why that is, and then we can maybe bring in these questions which are more specific.
Yep, okay. So we are underweight China because the growth in the China market over the past 5 years in particular has been driven by that internet space with the high growth companies. And these companies don't commit to paying a dividend, and they don't have any intention to grow dividends going forwards either. And for our fund, we're looking for stocks that pay dividends and have the willingness and commitment to their shareholders to keep sharing their earnings growth and their business growth through distributions to shareholders as well. So we avoided the internet stocks for that reason. And I think I mentioned this earlier, but we have benefited from not owning those internet companies, particularly as regulations have tightened over the past 2 years or so. But we do like the Chinese consumer story. I think one of the biggest demographic stories in Asia is really that growth of the middle class across the emerging markets, which of course includes China as well. So we're always looking for ways to play that China aspirational spend angle from companies that perhaps are not listed in China. So we hold some stocks in Hong Kong, for example, or in Singapore, where the businesses have grown into the Chinese market precisely to take advantage of that growth. So that's what we've done. It looks like we have very little in China in the fund, but we do look for access to that consumer story via companies that are on better PE multiples, via companies that are listed on exchanges where regulations are perhaps more stable, and via companies where we get better disclosure and transparency from the management team as well.
Sure. We've had a question. If tech and internet stocks have been driving growth, then is the Chinese clampdown, so to speak, on internet stocks not counterproductive?
Yeah, so our tech exposure, the overweight I mentioned before, that really comes from the hardware sector. So we have no Chinese internet exposure at all. The one internet company we do have is a mid-cap company called Momo.com. And that's a Taiwanese mid-cap firm that is basically like Amazon in Taiwan. And that's a company that we've owned for many years, but over the past 3 years, it's gone up tenfold. So it's done very well for us, but we don't have the internet stocks in China that you're all very familiar with and that you read about in the news. The bulk of our technology exposure comes from hardware. So that's companies that are making your handsets, or they're making the semiconductors that go into the businesses that grow with internet. So you can imagine as you're all working from home and you're all learning from home, then you all need better PCs, you need better screens, you need better Wi-Fi, you want to upgrade to 5G. So these are all the hardware companies that are making that possible. They're providing the building blocks for everyone who wants to use more and more data. So these are the holdings that we have, and these are the companies that have good balance sheets, that can pay good dividend yields. So that's where our technology exposure is coming from. We don't have the internet stocks because broadly they've been slightly slimmer in terms of margin, and they don't commit to paying dividends either.
Speaking of China in the news, I'm just thinking back to last year with the Evergrande scandal. I'm going to take a gamble here and say that you've probably not been affected by the property issues in China. But speaking more macro, do you think that the sector continues to be at risk in China?
Yeah, I think it's difficult to be in any regulated sector in China at the moment. And I think one of our core strengths has been having analysts and fund managers on the ground. So we have our colleagues located in Hong Kong and in Shanghai who are covering the Chinese property cycle as well as the sector. So as you correctly imply, we've never held the over-leveraged Chinese property names. I think we've actually flagged it internally for many years now as like a high risk sort of stress point in terms of houses being built without there being real demand for them, and companies using low interest rates globally to fund capex onshore in China when they don't have sales committed to these buildings either. So that to us is not a quality company. We don't see the future cash flow generation or the dividend paying ability from these companies. So we've actually avoided all the Chinese property stocks that have, graced the headlines over the past couple of years. And what we've liked about China property are those companies that are much more prudent about how they invest. They either have an investment properties portfolio that is giving them a good rental income, which they use to fund their own capex in very select prime locations where they know they're going to have sales and they know who their tenants are going to be. And that's the kind of companies that we've invested in, companies like China Resources Land, for example. We don't go into the speculative developers who have hugely leveraged balance sheets.
Brilliant. Maybe we'll move on from China now. What's your favourite market in Asia at the moment and why?
Oh, my favorite market. So, I mean, as an income fund, we do like the high yield markets. And I think Australia, for example, is having a very good run at the moment. So this turn towards value has certainly helped a lot of the companies in Australia benefits. And of course, something that Andrew alluded to earlier with the commodity price cycle that we're going through now, then that's really helped a lot of the commodity players in Australia as well. And once that industry is doing well, it seeps into the banking system, it seeps into the retail system. So I think the Australian market has had a very good run, and we see some good prospects for 2022 as well. And I think some of those companies are where we're basing our minimum dividend targets for this fund on as well. But we also have very good sort of quality companies beginning to start paying dividends in the more emerging markets of Asia as well. So India, for example, is the country where we used to not have many holdings at all, but over the past 4 years, we've added consistently into the Indian space because we're finding more companies who are willing to share what they earn with shareholders, and they're enjoying good growth. And they're actually playing into very good sectors as well. So we've got companies like Power Grid of India, which is a bit like the national grid of India. And not only do they manage that energy transit systems, but they're investing into new energy sources for the future of India. And that includes things like solar farms across Rajasthan. So we find that, you know, where they direct their capex is a very sustainably thinking way of investing for a company in India. And of course, we like the fact that they have this steady cash flow stream that supports a dividend as well. So that's been one of our good finds in a country where historically dividends have been quite hard to come by.
You mentioned energy there. How much impact are high energy prices having at the moment on Asian economies and specifically the portfolio's holdings?
Yeah, so where we benefit from energy is in some of the commodity players, as I mentioned. But of course, I think inflation comes through as a risk for most companies and for most fund managers trying to look for companies that are giving earnings growth. So the risk to earnings growth in Asia as well is really the extent to which companies can manage their margins and that inflationary pressure that we see across the world at the moment. But one of the things I'd just point out is that kind of inflation surge that we've been seeing globally, that's not been quite the same in Asia. So obviously energy prices being higher, that's something everyone has to deal with. But food prices have not gone up very much. So if you look at inflation in Asia, it's actually surprised on the downside in many markets. And a lot of the Asian countries are actually running inflation below the target level that the government has set. And that really comes down to being in control of your own food and agriculture and being able to control food price inflation at a time when energy prices are so strong. So we've not avoided energy price inflation, but I think you'll see that the surprises here have sometimes been very contrary to what you've seen in the rest of the global markets.
Is solar power investment, which you mentioned in India, is that something you're seeing across Asia? Obviously, it's a good area for income in the UK. Is that true to say for Asia? And is it something you're getting exposure to?
Yeah, solar is still very new in Asia. There are definitely companies that are investing into solar, and the exposure we have would be via the big utilities like Power Grid of India, who have the balance sheet and the cash flows to be able to make that kind of investment and partner with strategic know-how owners in order to do that themselves. But it's still very small in terms of the risk that they put on. And I think that's important to us because we need technologies that work and make money in order for these companies to remain dividend payers. I don't think it's mature enough yet across some of the emerging markets here for it to be a dividend stock. So we don't have any pure play solar or renewables companies within the portfolio today, but that's certainly something we look at. And obviously not all 40 of us are income fund managers. We're looking for ideas for all of the portfolios that we run in Asia. So we cover all these companies as well. And if they turn into income stocks or they look interesting from a dividend perspective, then that would be flagged to me and my income colleagues, and we'd be able to try and think about positioning that into the portfolio for the future. But we're very interested to do it. We just haven't found one that offers us the good price point as well as dividend.
Well, it's definitely an area that people are becoming more aware of and realising it's possible across the globe. With food price inflation, are there some markets that are more vulnerable to others? Obviously, you've got India, which is quite vulnerable to, you know, monsoon season, for example.
Yeah, so I think India probably is the most vulnerable in that sense, and maybe perhaps some of the more emerging markets as well. So Indonesia, for example, but the country where we do get the most weather-related food inflation chat is India. And that's been the case for many years. And I think that's probably the market where we've seen the most volatile inflation extremes over the past decade as well. And I think, again, although we don't invest in any of the food companies in India in this particular fund, we do keep an eye out to see which companies can perform well regardless of monsoons and regardless of inflation cycles in India, because I think that's an important risk that you take on as an investor in that market. And I think that's one of the benefits we have from having been in the region for 30 years, having these people on the ground who've been able to cover these markets for such a long time, is knowing which companies can outperform, which companies are resilient, regardless of political backdrops, regardless of monsoons on any given year, and really being able to drive that earnings growth, regardless of what inflation might be in any one particular year.
Sure. First COVID question, even though the economic drag of COVID is abating, but we have seen, like especially in China, it's not gone away. Which Asian markets do you think are still to see the strongest recoveries from the pandemic?
Oh, well, definitely China, where we're still having a zero COVID approach. And I think a lot of markets in the region are only just beginning to open up as well. So as I was saying, I'm based in Singapore, and we've just recently let everyone meet in groups of 10 from 5. It's been 5 for a really long time now, but now we're allowed to meet in groups of 10, and we're allowed to not wear masks when we're outdoors, but you still have to wear it in the office or inside buildings and supermarkets, etc. So even here, it's still not fully open. And I think that kind of pressure, that inflationary pressure from a mass reopening, is something that is getting delayed a little bit in Asia, because we are not reopening to the same extent that the UK is, or a lot of the Western markets are. So I would probably caution that there is a little bit of that reopening play still to come. And I would also probably caution that we shouldn't assume that everyone will reopen on schedule, because there is always that risk that there could be another variant, or there could be some other roadblock to these countries opening on time and on schedule. And of course, countries, you know, as big as China or India, where perhaps infrastructure doesn't reach all the most rural parts of the country as fast as, you know, you can do it in the UK, then it's a little bit more difficult to provide medical care and make sure vaccines are getting to the right people. And I think that's just something to be wary of when you invest in some of the more emerging markets globally as well.
Sure, thank you. Obviously, the approach is very bottom up, but we have had a question. What tactical and strategic changes, if any, have you made to the portfolio following the invasion of Ukraine?
Okay, so as an Asia portfolio, we don't invest in the Ukraine or Russia at all. So that's not been a big impact for us. And if we look at sales exposure on a look-through basis across our holdings, and it was around 0.5% of the whole portfolio. So it's always been quite small. And since then, a lot of these companies have come out and said they're going to stop making sales to Russia, as you can imagine. So it's probably something even smaller now. So there isn't that kind of impact on the portfolio. But of course, it has meant that the supply disruptions that we've seen globally during the pandemic, during the China-US frictions as well, these aren't going away as quickly as everyone had hoped or wanted. So this is creating extra pressure on supply chains, people waiting for components, people waiting for key raw materials. So that's something we're aware of, particularly in some of the supply chain heavy industries like technology or like batteries, where they have certain exposure to Russia and Ukraine. And I'd also just highlight that energy discussion we had as well. I think higher energy prices, that's also going to affect Asia, and that's something we look at from a margin perspective as well.
Another issue that has affected global markets is the supply chain crisis. Have any of your companies been affected by that?
Yeah, I think all of them have in some ways. So I'd say very roughly about 30% of the fund is export oriented. So these companies in particular have had some sort of effect, whether it's their own supply chain or their customer supply chain. It's something that's affected them. And I think one of the big key strengths is that because the majority of the fund is domestic focused, and that sort of localization trend has benefited some of these more intra-Asia supply chains. So that's been positive in some ways for these companies. But I think the global supply chain crisis has definitely hurt the customers of a lot of our companies. But if you look at the tech companies we have, like I said before, they're global leaders in their space. There's probably only 3 companies in the world that can make semiconductors at the highest technology level, and 2 of them are in Asia. So people are willing to wait in order to get their supply, and also their customers are not just waiting for chips, they're waiting for their own customers to need what they're making as well. So I think it's a long chain of disruptions, but when we talk to them today, then what we hear is that kind of pressure is easing, and perhaps people thought it would be getting better by the second half of this year, but the Russia-Ukraine war, as well as some of the COVID-0 policies that have stuck in place in Asia, that's probably pushed out the full sort of easing of supply chain issues until probably 2023. So it's something just to be aware of in terms of how quickly you factor in earnings growth. But things are getting better slowly, but I think maybe it will take slightly longer than we originally expected if you had spoken to me 3 or 4 months ago.
Yeah, brilliant. You mentioned demographics earlier when we were talking about China. Obviously, China's got a more aged demographic due to its historic one-child policy, but then you've got countries like Vietnam with a more youthful population. How important is changing demographics in your thinking?
Yeah, and it's not just age. I think it's the way people consume. So even if you have a slightly more, top-heavy portfolio profile, the population profile even, then I think it still makes a difference if you're just growing internet penetration, for example, or people are discovering e-commerce. I think that's one of the big things we learned during the pandemic, is that even countries like Taiwan, which is a much more mature population profile, you can have companies that grow tenfold over 3 years because people are discovering online shopping for the first time, and their habits aren't changing now that the physical stores are reopening in Taiwan as well. So I think it doesn't matter so much what your age is, it's really about the adoption of new technologies or new products. Vietnam, like you say, I think it's got the 2 sort of prongs of a young population, a very literate population, and aspirational consumers as well. As they become better educated and they become more wealthy, they want to spend more, they want to start protecting assets that they didn't have before. So I think that's a really exciting market to find new companies. And again, we look at Vietnam quite closely as a firm, because we run products that are into some of the small cap markets as well. But when we look at it from an income fund perspective, we haven't yet found companies that provide both dividend yield and that offer that quality of business model, looking out for 3, 5, 10 years in terms of a safe haven for the money that we're investing. There's also a limit on foreigners owning stocks in Vietnam, so you end up paying a premium as a foreigner, and that adds to your PE multiple as well. So that's just something to bear in mind, that we would want to, when we look at stocks and we look at the price we're willing to pay and we factor in some of the country risk premiums, then it does end up getting quite expensive to invest in Vietnam. So that's something we're willing to wait on. We know it's a growth market, our eyes are on it. And when we find the right stock, then again, that's something we're very happy to consider for this fund as well.
On that note, what sort of yield are you able to achieve on the underlying portfolio?
So the fund is yielding around 4%, and that's a premium to the 2.2 or so that the benchmark is yielding. And that's really coming from the dividends that we collect from our stocks. So I mentioned earlier that we don't want to invest in companies that pay no dividends or have no intention of growing dividends in the future. So I think as a rule, the lowest yield in the fund can be something, close to 1%, but that will be because the shares have done so well. So I come back to this Momo.com example. You can imagine if the shares are up 10 times, then even though they've grown their dividend per share every year, their yield has dropped from being 4% to being 50 basis points now. So we reflect the lower dividend yield by having a smaller weighting in Momo.com today. But if you look at the other end of the portfolio, then we've got stocks that yield, 6-7%. So we're always trying to make sure that we are generating good dividend income in this fund so that we can keep growing this dividend to shareholders, because ultimately we want to be able to fund that from the revenues we collect every year, whilst also growing what we pay out to our shareholders too.
And what sort of growth rate are you expecting in dividends on the underlying portfolio?
Yeah, so I think earnings growth for Asia is higher than the rest of the world if we look at 2022 forecasts. So we're looking at something around 5% for Asian corporates, and that's based on the benchmark. So if you assume, even if everyone kept their payouts the same, that's a 5% dividend growth amongst the companies in Asia. But I'd just say that there is a bit of a trend for companies to try and pay out more where possible, where payout ratios are very low. So we're coming from a low base in Asia, so there is scope for that payout ratio to improve in the future. And if you look at dividend growth in the region, then it's been much higher over the past 10 years than it has been across the other global regions. So Asian dividends have been growing something like 10-12% on CAGR over the past 10 years. And that's certainly higher than what you've seen in the US or Europe.
Brilliant. And just going back to Vietnam briefly, we've had a couple of questions. If Vietnam goes up in the emerging markets index, would you be more likely to invest in Vietnamese stocks, or would you consider investing through an investment trust as a way of getting exposure to Vietnam?
Yep. So on the investment trust, that would probably be a no, because we like to pick the companies that we invest in. And each company we pick for very specific quality reasons. And I think going via an investment trust would not give us that selection, and we would have to take whatever they put into their portfolio. So I think that's not going to happen. And I also think we would invest in Vietnam when we are ready, in the sense that the companies that we look at already pass our filters for dividend, for growth, for quality, and on valuation as well. I don't think it's a case of looking at what they are in the benchmark, because you'll see that, even China, which is 35% of the benchmark, we're quite, we've held a big underweight to that position for a long time. So it doesn't matter that it's big in the benchmark. I think what we want is to pick the companies that give you the best growth and dividend possibility in Asia. And I think we're going to stick to that. So it's not really driven by the benchmark at all.
Sure, thank you. You mentioned the filters that companies go through. What's your ESG policy, if there is one?
Yep. So ESG, I would put into the quality filters that we use. So we engage with all the company managements of the companies that we own within this fund. And we engage with them on issues, going from water recycling for the semiconductor companies, talent management, their commitment to carbon zero, their commitment to reducing their greenhouse gas emissions. So it can cover like a really wide range of topics. But what we want to see from the company management is a willingness to engage with shareholders on these issues, but also a willingness to try and improve their own ESG standards. So we're constantly working with our holdings to try and secure them an MSCI ESG upgrade as well, because we feel that the work that we do on ESG for our companies, that's not really a cost. It's more about creating alpha in the future. And we believe that companies that have a good ESG framework and practices, who invest sustainably themselves into their business. These are companies that are going to outperform over the longer period. And these are the companies that we want to be shareholders of, so that we can have, a well-rated ESG fund that gives you, growth and dividend growth as well to shareholders. So we put quite a lot of emphasis in terms of that ESG discussions that we have with our company management teams. We record it and we keep track of it. We ask them every half year how they're performing against these milestones that we've discussed. And that's really what we've been doing for 20 years now, but perhaps there was less focus in terms of clients asking us about it, but we've always done that, and that process is only getting stronger. And our sort of reputation as ESG forward players within the region, is really good amongst corporates, because they know this is what we've been doing for so long. And now we're communicating it a bit better, and we're using all these third-party ratings to really signal what we've built up over many years.
Brilliant, thank you. We've actually hit our full hour for the show already. That's flown by. I think that's a nice note to end on as well with the ESG policy. Thank you very much for joining us today. Really appreciate your time. I think is it 7 o'clock there now?
Yep, 7.
So go and enjoy your Friday night.
Thank you.
And thanks. Thank you again to Andrew, and thank you to everyone that joined us today. There won't be a show next Friday because obviously it's Good Friday, but we will join you again the following Friday. Thank you.